Recessions are stressful, but they're also an opportunity to build wealth. If you're in a good financial position and you play your cards right, it's possible to do very well for yourself. You may have heard that rich people make even more money off these economic downturns, but it isn't just the 1% who can come out ahead. Focusing on defensive plays can help you to not only weather the storm of a recession, but also potentially take advantage of it. Here's what you need to know about how to invest during a recession. So let's jump right into the video. So the question is, how do you invest during a recession? You need to plan ahead to position your investment portfolio for an economic downturn, even if the next recession is forecasted to be mild. Therefore, invest as much as you can. Keep this in mind. When the market is soaring, it's easy to forget that what goes up can also come down. The easiest way to get rich during a recession is to invest as much money into the stock market as you can. When there's a recession, stock market performance declines. Consumers spend less and companies earn less, causing investors to worry. Some investors sell off part of their portfolio out of fear or because they need the money. For those who have money to invest, this is an amazing opportunity. Stock prices could drop by 20% to 30% or possibly even more. Even though it may seem risky, the market has always bounced back after recessions. If you invest more when prices are low, you can effectively buy at a discount and earn big returns when the market recovers. Invest in all-weather businesses that do not depend on economic growth to thrive or survive. Companies with high recurring revenue, such as subscription-based sales models, are less sensitive to economic downturns. Avoid companies with high debt loads, as they could have trouble servicing their debt if revenues and cash flows decline. They could also have trouble refinancing debt at maturity if credit conditions and lending standards tighten. If you're going to hold stocks during a recessionary period, the best ones to own are from established large-cap companies with strong balance sheets and cash flows. First, what is growth stock? This is a publicly traded share in a company expected to grow at a rate higher than the market average. So, when heading toward a potential recession is not the time to own growth stocks. Growth stocks, especially profitless companies that are tied to high growth prospects, mostly tend to do worse during recessions. Instead, consider more income-producing investments and dividend-paying stocks. For investors, dividends serve a few purposes. First, if a company has a long history of paying and increasing dividends, you can have peace of mind that it is financially sound and can survive most economic environments. Second, dividends provide a return cushion. Even as share prices decline, you still receive a return on your investment. It is for these reasons that dividend stocks tend to outperform non-dividend stocks during market downturns. As with most recessions, you probably will not see the next one coming, but you will likely see a sell-off in the stock market well in advance of a recession. When that happens, remember the first lesson. The stock market will usually begin to bottom well before the end of the recession. But where is your money safest during a recession? Many investors turn to conservative asset classes such as bonds during recessionary periods. Mutual funds may also be a useful area to consider, and so may established large-cap companies with strong balance sheets and cash flow. The best way to own dividend stocks is through mutual funds or exchange-traded funds, ETFs, that invest strictly in dividend-paying companies. Own defensive stocks in a recession-defensive names in non-cyclical sectors like utility stocks and consumer staples stocks tend to be insulated from those ups and downs. During a recession, defensive stocks can help protect your portfolio. Companies that sell essential services and goods, such as food, electricity, and shelter, are generally non-cyclical and less exposed to economic cycles. Also, consumer staples manufacturers weather recessions well, and there are several options to invest in this area. That's because consumer discretionary stocks tend to see strong gains when the economy is growing. They're called cyclical stocks, since gains and losses in this group depend on the rise and fall of economic cycles and consumer confidence. Sales of consumer staples, food, beverages, and household products are fairly recession-proof because no matter how poorly the economy is doing, people still need to eat and use toilet paper. Demand for utilities also holds up in a recession, helping utilities outperform other stock sectors during a downturn. The healthcare sector is also stable across the business cycle. If anything, when counties experience more severe economic downturns, healthcare employment seems to increase. Even during recessions, consumers need to buy food, drugs, hygiene products, and medical supplies. These are consumer staples, which are the last items to be cut from the family budget. So while companies selling high-end electronics and other discretionary products experience drops in revenue, companies selling food products and other basic necessities do not. Because of this, companies in the consumer staples sector are sometimes called defensive stocks, since they tend to remain resilient even when the economy falters. For example, data shows that the following types of companies outperformed the S&P 500 during the last several recessionary periods. These companies include Johnson & Johnson, Procter & Gamble, Conagra, and Walmart. These particular companies also pay good dividends, which strengthens their defensive profile. There are also mutual funds that invest strictly in consumer staple companies. For example, the Fidelity Select Consumer Staples. In economic downturns, cash is king. As companies cut back and job losses mount, it's better to be safe than sorry and beef up cash reserves during times of high employment. However, selling investments to get cash in anticipation of a recession is risky. You might sell prematurely and get trapped in cash as markets rise. A better strategy is to shift into investments that are well positioned to weather a recession. This is why keeping a certain part of your portfolio in cash or highly liquid securities like a money market mutual fund is always wise. Protect your income. Stable income is a key part of personal finance success, including building wealth. If you lose your job, you're probably not going to be able to invest much money in the stock market. To make matters worse, if your savings runs out, then you may need to sell low on your stocks to pay your bills. This is why it's so important to protect your income, which means ensuring you always have a way to make money. Cut back on expenses. Most important is that if you're spending less, you'll have more money available to put into the stock market. And trust me, no one ever says, "I wish I hadn't invested so much back when stock prices were really low." By reducing your expenses, you also give yourself more breathing room if your income decreases. Shop around for lower rates on auto and homeowners insurance. Get rid of subscription services you don't use often, and download coupon apps to save on groceries and household essentials. Keep your expenses low, make sure you have steady income, and invest as much as possible. That's it for me. All the best!